Kia ora and good morning, everyone. I'm Emma Mello from ANZ, and it's my great pleasure to welcome you to our final stream of the investment session. Today we're talking about responsible investing and wellbeing. We have a standout panel chaired by Phil McAllister, founder and managing director of Asset Magazine and Good Returns. I'd also like to welcome our experts. We've got Matt Mims at the end, MD and founder of The Investment Store, Paul Huxford, Chief Investment Officer at ANZ, Rebecca Swan, ESG Specialist at AMP Capital, Barry Coates, Founder and CEO of Mindful Money, and finally John Berry, CEO and Co-Founder at Pathfinder. We'll have questions throughout the session, so there'll be roaming mics, so please don't be shy. Ask those questions and those burning questions you've always wanted to ask about. So Phil, I'll let you get underway. Thank you.
Thanks for that, Emma, and it's nice to be here. Just a little disclaimer, in the last 2 days, I've been getting quite a lot of grief about the last cover of Asset Magazine, which featured all men, and I have much better gender diversity here today, so thank you, Rebecca, and thank you for whoever put the panel together. If you do have questions, we're keen to get questions, and the last time we ran a session like this, there was a lot of interaction from the audience, so if you do have a question, please let us know. It is quite hard to see you out there, so we'll try to see you. I wanted to start with Matt down the end here, just to set the scene, because you do some work with the Responsible Investing Association and have done some research on the state of the market. Do you want to give us a little update?
Sure, yeah. Thanks very much, Phil, and great to be here and have the opportunity to present today. Just by way of background, I've been involved in the funds management industry for about 25 years now in New Zealand, and one of my roles also is as a board member of RIA, or Responsible Investment Association of Australasia, which is the, I guess, the key industry association in New Zealand that champions responsible investing in New Zealand and Australia. So there's 3 things I wanted to briefly cover, and I'm conscious of time. I wanted to give just a real brief macro view on why sustainable investing is so important, so crucial. I wanted to give you my elevator speech, which I always do at these sorts of events, on the case for RI, and then just a real quick snapshot as to the size and the importance of the responsible investment market here in New Zealand. So I don't know if anyone's ever seen the movie the Monty Python's Meaning of Life. And there's a great scene at the end where Mr. Creosote is in the restaurant and he is full. He orders everything on the menu, and John Cleese, as the French waiter, comes up to him in the end and he says, "One more waffle in mint, Mr. Creosote," or whatever he says. To which Mr. Creosote says, and I won't exactly repeat what he says, but words to the effect of "bugger off, I'm full." And I think that there's a strong case to suggest that the world is full. There's 75 billion people going towards 10, pretty much wanting it all. And this, I guess, is an overriding theme around sustainability in terms of responsible investing and why it's so crucial. Does Monday the 29th of July mean anything to anybody here, apart from possibly your birthday? Okay, so it was sort of rhetorical, really, but it's basically called World Overshoot Day, or Global Overshoot Day. There's an organisation called the Global Footprint Network, and what they are is they're an international scientific organisation that basically tries to measure how much of the world's resources humankind use in the course of 1 year. And basically in 2018, mankind was using 1.7 Earths in any 1 year. So we're in what's called an overshoot situation. It just so happened that this year, on the 29th of July, we'd already used 1 year's worth of the Earth's resources. You have to go back to 1970 to basically get to a point where there was a balance between how much resource we use and how much natural capital or resources available in the world. Now, this is obviously important, and you might ask, how can we actually use more than we actually have? Look, without wanting to insult your intelligence, if you think about a corporate balance sheet, you've got ins, you've got outs, and you've got capital. And if your outs are greater than your ins, you're going to be depleting your capital. It's exactly the same in terms of the globe. What we've been doing over the last 50 years or so is depleting natural capital, and we see this in a number of ways, such as climate change, such as biodiversity degradation, the depletion of aquifers, etc. Now, I guess there's 2 stark choices choices that we face. One is because sooner or later the world will hit a balance, and one is that we let nature take its course, and this has obviously got quite significant and profound, dangerous impacts, and we could see that through things like famine, where there's going to be a natural rebalancing, or we could try and develop policy that actually tries to redress the balance ourselves, and that's really what the Paris Climate Accord is about in terms of climate change. It's what the UN's Sustainable Development Goals are about. It's trying to develop policy internationally that will redress that balance. And that's why you're seeing globally a lot of government-led initiatives, sustainable finance initiatives, that are looking to develop and direct finance policy globally to meet those types of goals. And we're seeing it in New Zealand via the Air Tier Circle and the Sustainable Finance Forum, which I know some of us are a part of. And obviously finance has a crucial role to play. That's, and part of that is obviously responsible investing, it's ESG integration, it's sustainable investing, etc. So finance is crucial in terms of this global well-being, bringing it back to the title. So that's my first point. Secondly, responsible investing, just coming back to basics, it's really important because there's strong evidence to suggest that ESG integration leads to better risk-adjusted returns, and I know we'll probably cover that off. It aligns values, the investor values, much, much better, so it creates a strong relationship between the investor, the asset owner, and how they're investing. And then finally, basically responsible investing drives capital away from bad areas of investment, tobacco, bad polluting, to much, much better areas of investment, such as sustainable activities like renewable energy, etc. Final point I wanted to make is that responsible investing in New Zealand is big business. The organisation I'm involved with, RIA, run a benchmark report each year. This year, or to the end of 2018, they identified $188 billion of assets invested in New Zealand being managed in a responsible way. Now, the data is always difficult to be completely accurate around, but it's around 70-odd% of professionally managed investments managed using some form of responsible investment. A lot of that growth has come over the last 3 years, in particular through a general recognition by the industry of its importance, but also through the KiwiSaver issues we had 3 or 4 years ago. So I would say that responsible investing is big business. I've gone on too long, Phil.
Thanks for that, Matt. Just the conference, the theme of the conference, and this is one for you, Rebecca, is very much around well-being and wellness. How do you tie that in with responsible investing?
Thanks. Hello. Thank you, Phil. So I think responsible investment and well-being actually go hand in hand, because if you think about what Matt's just described about what responsible investing is, it's actually talking about the holistic well-being of the planet and therefore humankind. And I think, there's lots of different aspects to responsible investment that also contribute to well-being. If you think about some of the intangible drivers that analysts are actually analysing when they're looking at the value of a company and how they're going to invest in, they're actually taking into account a lot of those intangible factors. I'll use the word softer, and I don't mean that in a negative way, but they can be things like health and safety statistics for a company. It can be, things about the culture of an organisation, those things that are very hard to value in a fundamental, traditional financial way, but are very important when deriving a view on a company as to, whether you want to buy the company or underweight or overweight it. Also, from a research point of view, you can look at things like, antibiotic use in farming and how that's having a massive impact on human society today, for example, because of the overuse of antibiotics in farming, so using it on healthy animals, not just animals that are ill, you're actually causing society or humans to have resistance to antibiotics, which means that longer term, we are going to be more susceptible to disease, more people are going to die from diseases that they shouldn't be dying from, and also it's going to have, for example, by 2050, $100 trillion impact from an economic point of view. So there's lots of different ways that you can look at it, but that's sort of some examples.
No, that's good. John, do you want to add to that and your view?
Look, one thing I'd add to it is when you look at surveys globally about the size of responsible investment globally, it is massive, and people talking trillions of dollars, and they talk about growth of 50% a year or whatever. And for me, the thing I kind of struggle with is there's a lot of definition about what is responsible and what is ethical, and some providers will just take out tobacco and then they'll say, well, I'm an ethical manager, and they'll be included in the surveys. And so it's not just quantitative data that interests me, it's also qualitative, which is, do people care? And the surveys around whether people care or not I think is pretty clear that we compared to when we launched our first ethical fund in 2010, where literally no one cared and it was just tree huggers. Now it's very much a mainstream thing.
Yes, it certainly is getting much more mainstream, and I guess, Barry, that brings you in a little bit with the work that you're doing with Mindful Money and how it's become more mainstream and the consumers are more focused on it.
Thank you, Phil. I set up this new charity called Mindful Money, basically on the premise that the public really wants their money to be managed in ways that are responsible. And Mindful Money was set up to facilitate that. So where our goal is to shift money at the moment, which is going into pollution and exploitation and human rights abuses, into more sustainable ways of investing the consumer's money. And we undertook a survey last year undertaken by Colmar Brunton. We did it jointly with RIA. And what the survey said is 72% of people want their funds to be invested responsibly, and 62% said if their funds weren't used responsibly, then they'd shift KiwiSaver funds. So one of the things that we've done in order to give validity to all of that is actually we have a website which is able to tell the public what the companies are that are invested in each KiwiSaver fund across 265 KiwiSaver funds. So you can go onto the website and you can see what's in fossil fuels, what's in human rights abuses, what's in animal welfare abuses, etc. And the reason is then to give people that level of information about what they're investing in, and then allow them to make the decisions to move to a more ethical KiwiSaver fund. We're new, we've been going for 2 months, but the response has been fantastic, and we're developing a campaign to take that out to New Zealanders. I personally think this issue is kind of at a tipping point. This is something that most people you talk to want to do. They want their money to be managed responsibly, but there have been barriers. And again, the survey that we did showed what those barriers were. Lack of objective information, it's too hard to find the right fund, there's not enough research out there. We're trying to overcome those barriers to give people, to empower investors to take those choices.
So through your website, are you picking up trends now of what people are looking at? What are those big trends? What are the big issues?
It's a good question. The two big surprises from the survey. The first is, number one issue of what people wanted to avoid, and this isn't all about exclusions, but exclusions are the way that many of the public enter this debate. The thing that they wanted to avoid most was animal welfare abuses. And I thought that was pretty amazing. It's not necessarily my top issue, but we tested, is this, just young people? But no, actually, it's across all the age groups and across men and women. And the other thing from the survey that has a really important implication is, if you read the international literature, you say responsible investing is primarily driven by the millennials, driven by the young people who don't have much money. And our survey found that's not true, that those over 60 years old have an even stronger commitment to responsible investing than the millennials do. And why is that important? Well, the older people have got the money. And this isn't just a kind of niche trend in the market where a bunch of kids want to invest responsibly. This is actually a large chunk of the market that wants to do this. And so I think it really changes the picture about how mainstream this actually has to become for providers and for the sector as a whole.
Thank you.
Sorry, can I just add a couple of things to that? So we've done some research too, and I think picking up on that point, I think the key thing, I think, why people find animal rights and things like human rights and labour issues to be quite big issues is because we can all relate to it a little bit more. You know, a lot of us have pets at home. You know, it's part of our day-to-day lives. If you look at, you know, the banning of the single-use plastic bag, it was so highly adopted because we could all relate to it so well. For climate change, for example, it's such a massive issue. It can seem quite overwhelming for people. So I think but it's growing, and the awareness is growing as well, which is fantastic. But so for these other issues, you know, they're more relatable in day-to-day life, and I think that's why they keep on coming up as being big concerns.
I'd reiterate that. I think the survey work that we've done suggests that it's about 80% people care. So, you know, hugely important. And, you know, one of the key things I think that, you know, people like Barry are doing, raising the awareness of this, and that's going to drive engagement for us, which we think is really important looking forward.
So, Paul, ANZ did some surveys on customers recently. What did you find in that?
Well, it's about 80% of people care about it. So it's something, I guess we look at it two ways. So we're aware of what our underlying investors' expectations are, and that will change through time. So we need to, you know, stay on top of what expectations are. But we also, as an active manager, we're firmly of the belief that if we can take into account, you know, ESG factors, these are some of the drivers of long-term returns. So I guess we're in this fortunate position through having scale. You know, we have a dedicated ESG manager, but we also integrate through all of our processes in terms of trying to find risk, but also opportunities. You know, it's a complicated world. You know, that Matt is describing, and the way in which we think about that is, you know, all of the academic research suggests that, you know, maybe there's not a cost and maybe there's a benefit, but our view would be if we can remove some risks, you know, whether that be climate change, whether that be through fossil fuels, and deliver the same return, so we're delivering, you know, the same returns with lower risk, then that's a much better outcome, which is why we're enthusiastic about the topic.
So as a manager, as preferences change around the issues which people are worried about, does that mean that you're going to have to change your stock selections and how you invest? Are you going to have to react to that?
Well, the world is just like anything. The world is changing. You know, we take a long-term view, but every day, you know, we come in and we get new information, and you know, we need to assess that, whether that's a composition of a local board, you know, that we like more perhaps, and so perhaps that might mean that we're happy to pay a little bit more for a particular company. You know, relatively challenging. How do you build these things into your process, and how do you precisely, you know, price environmental risk? But you know, there's certainly things that we have to be thinking about, because you know, we don't want to be waking up and finding that, you know, trends are moving against things in our portfolio.
And John, coming to you, you know, you've got your new KiwiSaver fund, which is responsible investing. How do you drive your investment approach there?
I suppose there's thinking about responsible investment. There's two sides to it. The first is, what is the value set you want to include in responsible investing? And for me personally, I know a lot of people, there are some industries I just do not want to invest in, and that would include, for example, tobacco. If you use cigarettes as the manufacturer recommends you use them, you will kill yourself. And I don't want to be part of an industry that does that. By engaging with that industry, I'm not going to affect change. So, you know, there is the exclusions layer. But what we're particularly interested in is not just being negative, because you're not going to change the world by being negative and just ignoring a problem, but as by being positive and engaging with companies and focusing investment. You know, we run 4 themes: water, renewable energy, data centres, and forestry. And they are themes that are absolutely changing the world. So it's giving positive themes to consumers as well to get them excited. And you know, as providers, I think all of us need to remember, and in the industry, we need to remember, consumers do care about this. And if we go back to 2016, which is the first time it really hit the headlines in New Zealand, controversial weapons, which is cluster munitions and chemical weapons and you know, landmines, that was only $40 million of KiwiSaver, which is just over 0.1% of the total KiwiSaver asset base. But that was front page news for a long time. And we need to remember as organisations, not just individuals care about it, but we need to be looking forward. And the point made earlier about do you change over time? You absolutely change over time. Social values change over time. You've really got to be connected with investors and change your process and your thinking over time.
So that was interesting where the media got onto the munitions and stuff like that. Do you think that we're going to see more of that happening where the media pick up on an issue and it's going to hit the managers?
Look, I absolutely do. And there was a US Supreme Court judge called Brandeis who said sunlight is the best disinfectant. And everyone knows that saying because we used to use it when you issued a prospectus. You'd say, oh, sunlight's the best disinfectant. I've disclosed it in my prospectus, but it was a 100-page document and no one saw it. But what people don't know is his saying was actually sunlight is the best disinfectant, but street light is the best policeman. And what he was saying there is that technology can go further than just, the sunlight, and that's where I see tools like Barry is introducing to the market, where the holdings in KiwiSaver are disclosed. They're on the government disclosed website, but no one can use them. What Barry has done is scrape that data and put it in a way that people can use it. It is creating that street light for investors, and I think as providers and as an industry, we need to be really cognizant of what we're communicating to investors and consumers and our clients and what we're actually doing. Because if there is a gap, technology is going to discover that gap. We have to be authentic in what we're doing.
So one differentiation, or one thing just to tease out a little bit, is the community expectation on us as financial services providers. So exclusions are great, and that's excellent. But I actually think that there's more of an onus. We need to be advocating for change. Things that we're owning, questioning. Asking, pricing stuff appropriately. So I think, the world where, it was just about exclusions is gone. And, looking forward, I think there's an advocacy role here to change companies' costs of capital, right? For things, that we don't like, and, maybe lower it for things that we do like.
I was just going to say there's been a really good example of that this year, following the terrorist attacks in Christchurch, an initiative championed by the New Zealand Superannuation Fund, where they and some local investors, and then it really snowballed into a global movement, started to engage social media companies around their use of streaming online. I think it now represents something like $14 trillion globally, which is a huge amount of money, and so that's the power that you can have around certain courses when you actually start to proactively engage, and there are other examples of that as well.
I think one of the things I'd just like to add is so responsible investment isn't actually about excluding investments. So it's a part of the investment process. It's defining your investable universe. It's a way of aligning your values to the way that you invest. But then, and John's picked up on this, and so has Paul as well, around the positive application of looking at ESG factors, so tilting a portfolio towards, maybe renewable energy or forestry or clean tech or whatever it may be. But engagement and being an active owner is one of the biggest things that an investment manager can do and have the biggest impact. And part of the responsible investment process as a manager is we're also really responsible for being really transparent about what we do and why we do it, and what framework and what governance process we have around the decisions that we do. Because this allows us, when, say, the media does have their next little bugbear on something, that we can say, actually, these are our beliefs and our values. This is the framework that we use to assess this, and this is our, the solid process that we go through. And I think after the Christchurch attacks, that was really interesting. It's actually something that by the end of end of March, we'd actually already established that we were going to exclude civilian weapons. We had a solid governance framework that we went through to assess it. We made the decision, we communicated it with our unit holders, and told them why and why it was important. And then, I know that there are some other managers where when they were contacted, they hadn't even considered it. So by having a solid governance framework in place and being transparent about what you do, I think that's very important.
Barry?
Yeah, I think this is a useful discussion around strategies of how you achieve responsible investing. And implicitly, most providers in New Zealand have recognised that there are some things really you need to exclude. So most providers exclude tobacco and what's called controversial weapons. And I think there's a valid reason to do that, because the business model of a tobacco company is to produce stuff that kills you, and they can have all sorts of sustainability programs to improve their water use and, use less energy, but they're still a tobacco company. So, I think they should be excluded from portfolios. But there's a few other sectors like that you should say probably actually they should be excluded as well. So maybe pornography or gambling, or, I would add fossil fuels to that. So that's one aspect of exclusions. The other aspect of exclusions is there are some sectors that frankly don't look so great financially. So, half of the coal companies in the world have gone bankrupt over the past decade, and I think that there are certain sectors that you can look at and you can say, well, actually, there's a market failure here in pricing these assets. And it's a systemic problem, and I'd rather not go there, and my returns are going to be higher if I don't. And I think the fossil fuel industry falls into that category. But you kind of move on to engagement, and I think engagement's great, but you have to provide a convincing case as to why engaging. And I think all companies need to have adequate corporate governance, and that means that the people who own them should govern them. And so active corporate governance should be, I think, a norm rather than an exception. But if you just kind of go along to an AGM and you vote your shares and nothing happens, then actually that's not really exercising the influence. And some companies, frankly, don't really want to change their practices. And so it may well be that those companies should be excluded from your portfolios as well. Because if your engagement isn't actually achieving any results, then just engaging isn't necessarily the best thing to do.
So one of the things I can't help but chime in again. So again, active management, we think this plays to us because we do, put up changes to AGMs, we express views to boards. So, in this complicated world that we all face down, we think we take that seriously. The other sort of point that I wanted to highlight, the decision around weapons was an easy one. So like AMP, we were quick to act on that, but it's nuanced as well. So in New Zealand, we can buy products that are produced by an American conglomerate that own semi-automatic and military-style gun brands, and so you can either turn a blind eye to that, or you can go and ask, why are these products available? How do you get there? All of those types of things. So there is, the complexity in this, but I think I'd go back and say, that's the responsibility that we have as custodians, or as investors. We have to act on that.
I think, sorry, just another thing on the engagement. So engagement's just more than actively voting. So on the voting side, if you're voting against or sort of neutral on a voting issue, then usually you'll use that as a way to communicate with the company as to why you made that decision. And then also, of course, there's other ways of engaging as well, so not just voting. So, for example, around climate change, we use the TCFD framework. So we use that to question boards that we meet with. Being an active manager and being a large investment owner, it does give you board time with the boardroom, around the boardroom table, which is very valuable. And while it's not the only way of doing it, and also there's other ways of doing it, we also look at carbon footprinting. So we carbon footprint the companies that we invest in. So that gives us an understanding from our definition as to where a company stands. So then when we go and meet with the board around the boardroom table, we can say, look, what is your strategy to moving for a 1.5 degree world? We've done this analysis. This is how we assess and view your business. to have an open dialogue, and how would they refute that? So there's voting, there's engaging on particular issues. You can also engage collectively through the likes of the New Zealand Super Fund initiative around the mosque attacks in Christchurch. You can also join collaborative engagements like the Climate Action 100 or the Bangladesh Accord. There's so many other ways of engaging, and I think that's a really important role that active management play. And actually, not just active management. If you're a passive investment manager, you should also be voting, and you can also join those sorts of engagement initiatives as well. It just takes a bit of resource and time.
So do passive managers, do they struggle to manage the RI side of it because they don't have so much control?
Yeah, we'd say they do.
Well, I thought you would.
Well, look, I think if you're buying an index, I mean, we spend a lot of time torturing the data, and it's quite interesting. If we look at our international equities fund, the carbon weighting is 50% of index, and so our international managers are thinking about these things and seemingly pricing that risk and choosing not to do that. Whereas if you own the index, you're at a rate kind of double than that. So.
John?
Look, for me, if you're a passive manager, it's easy to exclude, but generally you'll be tracking an index or giving the money to an offshore manager, and you completely lose control of what is or is not in there. And as Rebecca said, there's so much nuance in how you make decisions, and the real challenge for us as fund managers is what we're doing is building a fund for thousands of investors. So essentially what we're doing is pooling money, and we have to come up with one value set within that fund that will suit all those thousands of people. And so there's a couple of things from that. One is all of us need to communicate really, really clearly what we believe and how we're implementing it in our portfolios and what steps we're taking for engagement, so people actually know what they're buying into, and that's really clear. And look, the other thing that is really important as well is people need to realise there is, what's in there, and they may need to compromise. And, if you went back a few years, people were just happy with saying, I'm investing ethically, great, I've ticked that box. Now people are saying, with animal testing, what are you doing? Are you testing consumer goods? Are you stopping testing on consumer goods? Are you stopping testing on pharmaceuticals? And they're drilling down into exactly what you're doing. And sometimes people need to compromise because you can only come up with one value set within the fund.
Quick comment?
Yeah, quick comment. Sorry, just on passive. So there's passive, right, where you're tracking an index. But then there's actually, in this day and age where we have heaps of digital technology things at our fingertips, you can actually do a lot more in the passive space. So you can actually have a carbon light portfolio. You can have exclusions. You can have a philosophy or a climate change philosophy applied, tilt it towards better scoring ESG companies, and actually have an optimised portfolio, which actually gives you kind of like a hybrid passive. But you can have your cake and eat it too. Yeah. So the landscape's evolving quite dramatically.
So another session I went to recently, they talked about if you're a responsible investor, you should never buy, say, US bonds because it's funding the military and things like that. What are your views on that?
Oh, so there'd be a lot of other things higher than US bonds. By the time we got to excluding US bonds, there's probably not a whole lot left. And it's not, in terms of, surveying, our end investors, that's not one of the things kind of that comes through. And in an uncertain world, I think, US bonds can provide a level of return, but there's not much left before you get to that.
Yeah. And I think, I was just going to say, in terms of credit, if you think about fixed income corporate issuance, really the rules that apply to equity should also apply to credit as well. So there's no reason why you can't apply screening or have ESG values in terms of investing in local and global credit as well.
So,
sorry, just to add on the bond side. So you can, obviously on the credit side, but also on the sovereign side. So in our Ethical Leaders Global Bond Fund, there's 46 countries that we exclude. There's a huge focus on green bonds and social bonds in the fund. So there's other ways that you can tilt the portfolio to get exposure.
So change your topic because time's ticking on. We've got the review of default KiwiSaver funds going on, and there's a suggestion that they should have a responsible investing mandate as part of what they do. Yes, no?
I'd say no.
I'd say
I'll come back.
I'd say absolutely yes, because the public wants it and they expect it, and there's essentially a duty on the government to put on rules that meet consumer expectations.
So,
With
one all so far.
my Sustainable Finance Forum hat on, I would say in time it will be a fiduciary duty to consider these issues. So yes.
I think we have that duty to consider these things, and that we are. I think the challenge is, how do you define responsible investing?
Yeah, and I'd say yes, because
Yeah,
I
yes.
think that New Zealand has got certain frameworks, norms around what's acceptable and what's not acceptable, like cluster munitions, etc. And there's no reason, if you're applying that broadly, you shouldn't apply it to default KiwiSaver providers, because I think it's New Zealand law and norms, and consumers expect it.
So, John, you lost that one. Why no?
Look, personal belief, I think the purpose of a default scheme is it should be low fee, it should be a temporary place that people park, and we need to give people as many reasons as possible to move out of default and into a more suitable, default which being conservative, into a more suitable fund, which may be a growth fund or it may be an ethical fund that matches their values. So people are going into default schemes at the moment. People care about investing ethically, and it's one way to get people to switch out of default. I think it would be really unhelpful if the large providers who are default providers can say to people, you find staying in default because it's ethical. For me, the default scheme just needs to be no frills, low cost, and the provider that has you in that scheme and everyone else in the market should be encouraging you to find the right scheme for you.
Yeah, we think we do, and we have to think about the risks that are presented, RI, climate, kind of all that, so we don't know how we wouldn't do it.
Yeah. Advisors, John, and I know you've got a view on this one, and you do have a role on the code committee. Advisors, should responsible investing be part of what they have to do?
Look, this is a personal view, not a co-committee view, but I would say yes. So Matt and the Responsible Investment Association submitted to the code working group that advisors should be forced to ask investors and their clients what their views are and have that taken into account with investing. The code that we've come up with is a very principles-based code, so we're not putting specific things in there, or you must ask your client these things. But if you look at a couple of the code standards, one on a product that you provide for your client has to be suitable for the client. I don't know how you can think a product is suitable or unsuitable if you haven't asked questions around exactly if they want any values taken into account. And the other is that a client must understand the financial advice you're giving, and again, they need to understand if responsible investment hasn't been taken into account, then I think they need to understand that.
Barry?
Yeah, I agree entirely that actually you don't know about your consumer until you ask the questions around areas like that. So requiring the question to be asked isn't predetermining the answer, but it is around giving them an opportunity to say what their preferences are. So I would be in favour of making it mandatory.
Anyone else have a view on that one?
Yep. I'll give you.
I thought you might.
Yeah. I'll give you. If I give you 5 reasons why I think financial advisors should incorporate it into their advice process. Firstly, I think the point that Barry made, because consumers are demanding it, it's important to consumers. Secondly, and we won't go and dwell on it too much, but you could argue that the law has provision for it, and codes 1, 3, 4, for example, in terms of codes of professional conduct, kind of can imply it. You could argue that it's part of an advisor's fiduciary duty when they're advising their clients. I think that it's that alignment argument. It's a very powerful argument that's sometimes overlooked. But if you are asking questions about a client's values and you incorporate that into the solution, then I think that's really powerful. And purely from a marketing perspective, there are still not that many financial advisors in New Zealand who are actually overtly incorporating responsible investing into the investment process. So it literally does give you a point of differentiation, and I think it's probably a good thing to talk to clients about. It's a good marketing angle.
And just final question I think we'll have, and it's to all of you. Global trends which we should be watching, which are coming to New Zealand, what are some of those? I know.
The first one I'd say is climate change. If you talk to people in Europe, 9 out of every 10 conversations will either start with or have near the front climate change, whereas in New Zealand it's probably 1 on every 10 conversations. I think we're a long way behind on that, and that's reflected in the investment products offered. And Rebecca talked about climate intensity or carbon intensity being taken into account in portfolios. We're just starting to see that in New Zealand now, which is great. I think we're catching up with the rest of the world. And the other thing I'd say is for people to think about with their business, whether you're an advisor or where you are in financial services, is just be really clear on your message, on what you believe in relation to ethical investing and responsible investment. Because I can go on websites and read 10, 15-page documents, which are wonderful documents of some providers where they explain their philosophy, but I can leave the document at the end and go, I really don't know what they believe. I really don't know. They've told me what their process is. They haven't told me what their why is. What do they believe and why do they believe it? And I think messaging needs to be clear.
Yeah, great.
So I'd certainly agree that climate change and sustainability more broadly is a trend. For me, a second one is particularly on finance. The people are waking up to saying, I want to know the impact of what my money does. That I think we're going to look back at some stage in future and say, you mean people used to make investments without actually understanding the impact of their investments? What an archaic thought, that they were just interested in returns and risks and things like that. Surely they realize that when they invest, it has consequences, and why wouldn't they invest using those consequences as part of their value system and their choices? And so I think that will become a norm. And the third thing I think is that governments will start to be more active in this area. If you look at the European Union with their Sustainable Finance Action Plan, the UK with their Green Growth Expert Group, China's got a lot of stuff happening on sustainability in government policy. Norway, Australia's undertaking a similar process to New Zealand. And here the Sustainable Finance Forum that many of us are a part of is starting to gear up and actually I think will provide a roadmap as to what the government could be doing in order to set the framework for finance to take sustainability into account, and secondly, to mobilise more resources for sustainability development.
Rebecca, global trends?
Yep, quickly. So yes, I believe the same thing around sustainable finance, having a more holistic economy, making the economy more inclusive for all New Zealanders. Second, I think the biggest global trend will be around impact investing. I mean, real impact investing. That means intentionally investing in a company that is providing additionality to an issue or a cause. That does not mean just calling it impact investing or impact washing. Intentional impact investing.
Paul?
Yeah, I'd agree with all of that. I mean, the climate change is going to be huge, right? But I think in New Zealand, where it feels, I mean, we're still too much about exclusions, and I think the conversation needs to move on to how are you building this into your processes? How are you thinking about risk, and how are you advocating? What are you doing? And I think, it's just going to continue to grow.
Yeah, and Matt, final word.
Thank you very much. I think it's all been very well said by the the panel. I just think that, we can't get away from the fact that this is a global trend. That I think, one of the things I think is quite interesting, which nobody else has mentioned yet, is this whole idea of lexicon and taxonomy. So it's a bit dry and a bit boring, but one of the challenges I think we've faced as an industry is understanding exactly what's meant by sustainable finance from a consumer level, and making sure that we're doing stuff that's true to label. And I think that will be a trend that we'll see take place. It's happened in the EU, or it's proposed to be happening in the EU, and I think it'll happen more and more, and government's obviously got a role to play in that as well.
Thank you for that, and we have 56 seconds left. I don't know if anyone has a question. If not, David, I knew you would.
Yeah. Thanks, Dave. We've got a methodology, a series of methodology papers on our website, which explains all of that. But basically, On exclusions, we're able to see what's in the portfolio and track those against the different sectors, so we can see who's excluding what in terms of what's in the portfolio, not just in terms of their policy. So there's a direct verification there. And so from our surveys with the public, they want to see exclusions in a number of sectors. So one of the criteria for getting onto our platform is having broad-based exclusions that include some of the major sectors like climate change and weapons. The second... Yes, yeah. So our data sources for that include data from rating agencies, include data from Bloomberg and other services. We use the Norwegian bank, so the Norwegian Sovereign Fund has a very well-developed research framework for exclusions. So we put those together into a coherent framework.
And with that, thank you, Barry. Time is up, so I'd like to thank my guests for taking part and providing such useful information. So thank you very much, guys.
On behalf of the delegates and the FSC committee, thank you so much for joining us today. It's really exciting to see the growth of RI in New Zealand. We've heard today about consumer engagement, but also how the industry's shaping and meeting changing expectations. So thanks a lot.